Pleasure to be here and to speak after Willem, who has, as usual, thrown out a lot of, let's say, interesting material, most of which actually I agree, but I think one can discuss at length some of the finer points. I wanted to come back to something that Willem already mentioned at the beginning, namely something on the origin of the crisis. And I think that is very important because what Willem mentioned, namely that Europe had been so disunited and slow to respond, was to a large extent also due to the fact that there was a widespread perception that this is an American crisis. And until the summer of last year, I think the finance minister of Germany said openly, oh, the Americans have some problems, but our banks are safe, nothing to worry about. And we know what happened next. And my central point is that we should not have been surprised that the crisis hits Europe as badly as it did the US. That's my central thesis. And the second point is then getting much more difficult. We are in Europe, so everybody's different. Everybody's different in a different way. And therefore, some countries claim, no, we are innocent, we didn't have any problems. And I wanted to go a little bit into the differences across countries, which explain, I think, why also there has been no joint response and why the priorities are so different from country to country. Now, let me see whether I can run you through some of the points which are a bit data heavy, I must admit, but one has to look at some of the crisis indicators to realize that actually the developments in the US and in Europe were quite parallel. I will concentrate in general on a comparison between the euro area and the US, taking as given that the UK is more or less similar to the US, more than to the euro area, but that we could discuss separately. Now, the recurrent theme of this crisis is actually nothing new for those who have looked at other crises beforehand, which is that you usually have in the run-up to a big crisis two things. You have a large expansion in credit or leverage and an asset price boom. Now, the precise location of the asset price boom differs from crisis to crisis. In this particular one, it was in the real estate sector. And the real estate sector is really of crucial importance to the economy. It has influence almost everywhere in mortgage lending by households, in commercial real estate, as collateral for enterprises who do their normal lending. And of course, it's a very large part of the bank's balance sheets. And therefore, the real estate sector, if it goes wrong, is the biggest sector that can go wrong in a certain extent. And that is why I want to concentrate on this particular sector. Now, at the beginning of the crisis, of course, was said, what happened was in the US, you had subprime lending, which we don't have in Europe. You had securitization on a large scale, which apparently we didn't have in Europe, and therefore we shouldn't be affected. But my central thesis is that if you look at two key indicators for crisis, namely asset price boom and leverage, you see that the data are completely comparable between the euro area and the US. And I think that should have told us beforehand that something was going on in Europe as well. Now let me start with the first point, which is the housing price bubble. Everybody is talking about the US, and the news almost every day is now, has the US housing sector stabilized or not? And therefore, I want to show you this picture, which shows house prices. For the economists here, quick parenthesis, is the ratio of house prices to rent, which is a variable which should be stationary. And you see first here the two lines, one is the US and one is Europe. It's not really important to identify which one is which, because you see that over the last decade, they've basically coincided. And largely, there have been some longer waves which have also been quite closely correlated. So the first point is that if you look at the US and Europe, the housing price boom has been almost exactly the same magnitude. The adjustment seems to be quicker in the US, downwards now, But if history is any guide, it will come in Europe as well. And it will last for a long time. In Japan, for example, house prices have been going down now for 17 years. Every year only a little bit, 1 or 2 percentage points, but for 17 years. So these house price waves and cycles can last a very long period. That's the first lesson. In Europe, we have nothing to really to gloat about the Americans. Let me also mention immediately one big difference between the US and Europe, which is that when we look at the US, we always look at house prices as a good indicator of the losses for banks. Why? Because in the US, most mortgages are no recourse. That means if you have a mortgage of 100,000, but your house is worth only 80,000, you just send the keys to the bank and you say bye-bye, the bank takes the loss and you are debt-free. That does not happen in Europe. There are some countries in Europe where you are liable for the difference forever. And that is very important to understand. In the US, actually the problem might be quicker to resolve because the banks take a hit, the government recapitalizes the banks, almost end of the story. Whereas in Europe, as house prices go down and consumers are poorer and poorer, they will have to reduce their consumption for a very long time to come. And that's one of the reasons why I believe that actually the crisis can last much longer in Europe than it does in much longer in Europe than it does in the United States. Now the second point, the credit expansion. Again, here you have to look at the data, and what I present is just a very simple indicator of leverage, which is the liabilities of households relative to GDP, which is more or less their capacity to repay. And why don't you just look at the last row, which gives you the change between 1999 and end of 2008. You see, in the US, there has been an increase of around 30 percentage points of GDP in the leverage of households. In Europe, not nothing, but only 1/2. So I can say, yes, it's true, the US household sector expanded recklessly, as many people say. Actually, in the corporate sector, and that is very important, there has been no increase in leverage on both sides of the Atlantic. And that's why it was widely expected that the corporate sector shouldn't really be touched. But the key difference here is that the leverage of the corporate sector in Europe is much higher. So it means it's much stronger affected by financial markets disturbances. That's another hint why in Europe the differences, that the impact of the crisis has been so large. Because with the corporate sector so much exposed, the risk aversion and other dysfunctional aspects of the banking system which were created by the Lehman debacle had of course a much stronger impact than the United States. But I think the perhaps more interesting aspect is that if you look at the financial sector, not just banks, but the financial sector overall, you actually see that the increase in leverage has been higher in Europe, and the level also, than in the United States. So all these people who talk about the imprudent US banking system, too much leverage created there, and that is then swapped over to Europe, we have to recognize that over the last 10 years, more leverage has built up in Europe than in the United States. So maybe the spark that ignited the powder was the subprime issue in the United States. But we accumulated, I would say, even more powder on this side of the Atlantic than was lying around on the US side. That's a key aspect that one has to keep in mind. This crisis, we prepared very well for this crisis in Europe. We created all the ingredients that were needed, and actually on a larger scale. Actually, when you sum up all sectors, you see that the increase in leverage economy-wide was exactly the same by chance. I didn't make up these numbers. It's around 80% of GDP. But this is if you just sum up all sectors. So the first point, a really big message is that in Europe we have the same symptoms pre-crisis, and we probably have therefore to expect a similar problem as the United States, but with a slower development, because in the US the problems have come out much quicker into the open, because via securitization all future losses are compounded into one market price today.